the terrain for banking is changing. The sector is no longer one which was characterized previously by a few banks, doing business from one part of the country all the way to another, from west to east, from north to south. New players have come in. We have now fintechs, some which were previously only telecoms and have now added on their products, the financial products. Others were a mainstream, financial technology fintechs. So you are no longer looking at a bank as only a building located on some street. Now, but on top of that, the customer has also changed. You now have a customer who is very, or not very, but who is impatient compared to the previous customer who was willing to go wait in a banking hall, to a customer who is now saying, I have 100 things to do in a day. I cannot afford to be in a bank for 1 hour seated waiting for a transaction. So yes, the customers are changing, but also the customers are now spoiled with options. So again, I can do everything I want on my phone. I can do everything I want on my computer regarding my financial transactions. So that is now a challenge, because if for banking institutions that were traditionally, branch-oriented, physical branches, now their systems may not be even compatible. If we are only looking at people coming and signing deposit slips, now people are doing using fingerprints, thumbprints, to be able to transact. So it means some of the equipment that was previously used in banking has become obsolete, and again, new equipment has come on board. So those banks which are not moving at the rate of the technology development, at the rate of the generations of clients which are changing from the traditional bit patient one to the now very impatient, very convenience oriented, don't want stress, don't want to spend a lot of time doing the same thing, then there's now that challenge to transition if they are to keep relevant. So that's basically what it is about. Trends, of course, they are constant. Policies that govern the financial services sector are also now transitioning. For example, previously, under the Tier 4 institutions, we did not have financial institutions such as fintechs. They are now included. So for financial institutions that are not advancing or that are not modifying the way they do business, their policies, their teams, even their products and their market propositions are not adjusting to fit the current banking client, then those ones are becoming obsolete. And indeed, as you observe, you'll find that, for example, you start hearing of things such as one bank has closed all up-country branches to only leave 2 or 3 branches within Kampala where most of their business is concentrated. Or some have even closed shop and they are now going into markets that their business model can apply. Others have gotten into new partnerships so that they can keep relevant. You find now a bank is partnering with a fintech company which has a platform that can enable online banking or digital banking or mobile banking. So those who are not able to adjust to the current trends are definitely becoming obsolete, are losing it in the market. And as the saying goes, it is no longer the big companies eating the small ones. No, it is the innovative companies which are eating the non-innovative or conservative ones. What ought to be done to harness the opportunities and deal with the challenges of the financial services sector trends that we observe, specifically for financial institutions, we must ensure that we are adjusting to match the current trends. Ensure that from governance level up to the last person in the institution, they have moved. They know they are dealing with a new type of customer who is impatient, who is quick, who is spoiled for choice, because there are other adverts popping up on their phones about the other financial services providers they can subscribe to and get the same service or even better. So there must be adjustment in terms of governance, internal controls, staffing processes, policies around how the financial institutions offer their products and services. Secondly, they must be more socially inclusive, because if you're not socially inclusive, then you're going to miss out part of the population, which is a source of revenue for you as a financial institution. So capitalize on the digitization, capitalize on the large phone networks, capitalize on the internet outreach to reach the customer that a previous brick and mortar bank branch would not be able to serve. So I can have a client from Gulu, at the same time a client from Sora, at the same time a client from Rakai, at the same time a client from Masaka or Mbale, all transacting at the same time. So in terms of social inclusion, look at reaching into markets that you've never been reached before, because there are now options and technology to enable you get there. Thirdly, be sensitive to the environment in which you operate. Yes, trends are changing. These days, you'll have niche markets which are associating with financial institutions because of concerns, say, on certain geographies or certain processes or certain environmental issues. In addition to the considerations on good governance and internal controls and social inclusion for financial institutions to stay relevant and sustainable, we now need also to have consideration for the environmental aspects of the businesses we support and also of the clients we support. For example, there is an increasing drive and trend towards green financing for all sectors: construction, agriculture, education, energy, technology, and the rest. So there is need to have products that match the increasing priorities or the priority directions of the clients who borrow, but also of the investors who are bringing in money into these financial institutions.